Hi. In our last mini lecture, we left off with how to prepare adjusting journal entries. Of course, the next step would be to post or copy the information from the adjusted journal entry into the T accounts. So today we will pick up there and learn how to both complete the accounting cycle and the accounting year. So we're going to be focusing on learning outcomes 4-3, 4, and 5. Okay, so here's the unadjusted trial balance on page 166 of our textbook. And here are all the adjusting journal entries that were prepared. The next step would be to post those. This is page 167. And it shows that all of our adjusting journal entries have been posted. Let's take a look at one, for example. Our first entry, A, says to go to the supplies expense account and post a debit to supplies expense. And there's the debit to supplies expense. It says also to post a credit of $350 to supplies. And there we go. So all of our adjusting journal entries have been posted. Let's go to our Accounting Essentials handout for just a moment. The adjusting entries have been prepared and posted. Our next step is to prepare the adjusted trial balance. After the adjusting entries have been made and posted, we do another trial balance, listing the account names and their adjusted balances to check on the equality of the recorded debits and credits. And we prepare this in just the same way that we prepared the unadjusted trial balance. We're simply going to list the name of the account and its balance on our adjusted balance sheet. So for example, cash, $16,900. Since it's a debit balance, gets listed in the debit column. Accounts receivable, a debit balance of $3,750, gets posted in the debit column. And we would do that for every single one of our accounts. And then we would add down to make sure that the total debits equal the total credits. If they do so, then the next step would be to prepare our financial statements. So let's take a look at those. The first step is the income statement, right? We start with our income statement first. We have the name of the company, Noodle Cake Studios, Inc., the name of the statement, income statement, and the time period covered for the month ended. Then we have our heading, revenues, and we will list our revenues from greatest to least. And we only have two revenue accounts here, sales revenue and service revenue. Those amounts get listed and totaled. Then we have another heading, expenses, and we list all of our expenses from greatest to least, with the last one being income tax expense. And so all of those amounts are going to be listed and then totaled. And then we use our formula. Total revenues minus total expenses gives us our net income of $800 because the revenues were greater than the expenses. If the expenses were greater, then we would have a net loss. Our next financial statement is the statement of retained earnings. So again, we list the name of our company, the name of the statement, and then the time period covered. Both were for the month ended September 30th. Since this is a brand new company, we don't have any earnings from the past. We have earned no net income from the past. So we have a beginning retained earnings balance of 0. And then we add in our earnings or our net income for this period, for the month ended September 30th, and that's $800. And then we subtract out any earnings that we distributed to stockholders. And we have no dividends. We can check that on our unadjusted trial balance. We have no dividends on our adjusted trial balance, we have no dividends to subtract. So our ending balance in the statement of retained earnings is $800. The next step is to prepare our balance sheet. And that would be page 169 from our textbook. On this statement, we take the assets, liabilities, and equity accounts from our adjusted trial balance, except we go to our statement of retained earnings to get our ending retained earnings balance. So we list our assets here. Now we've separated them into current and non-current. So we have categories here on our balance sheet because this is a classified balance sheet. We have separate categories for current assets and current liabilities. The reason is it will make it easier for our readers of our financial statements to perform their analysis on these companies. Remember, our whole goal in financial accounting is to provide useful information to people and organizations who use the financial statements to make decisions about companies. So remember, current assets are assets that are going to be used up or turned into cash within 1 year. So we have listed here cash, accounts receivable, which will be turned into cash, supplies, which will be used up within a year, and prepaid rent, which will be used up within a year. When we get to our non-current assets, equipment, software, logo, and trademarks, we show the original cost less the accumulated depreciation. Remember, accumulated depreciation or accumulated amortization are both contra assets. They are used to subtract from long-lived tangible assets or intangible assets the amount we estimate has been used up. So the amount reported here is a net figure. Cost $9,600 for the equipment, less $400 in the accumulated depreciation, or how much it's worn out so far, gives us $9,200 as our net equipment. The same thing with the software, except because this is an intangible asset, we call it amortization instead of depreciation. Then we total down to get our total assets. Our current liabilities heading is for liabilities or debts that have to be paid off within a year. So we total those, and then we add in any long-term debt to get to total liabilities. And all this information on the balance sheet can be obtained from your adjusted trial balance, except for the retained earnings. That must come from the statement of retained earnings. And that tells us the ending balance for September 30th is $800. Notice that the retained earnings balance of 0 is the beginning balance. Okay, so our total liabilities and stockholders' equity equal our total assets. Now, if this is the end of a regular month, we would just continue on with our next accounting month. We would be done with our end of period procedures. But if it is the end of a fiscal year, which is any consecutive 12-month period, then we have to close our temporary accounts and prepare our records for the next accounting year. Let's go to our Accounting Essentials document for Chapter 4 now. This should be the last page of that document. And it says here, this last step is only performed at the end of the accounting year, year end only, after the financial statements have been prepared. It gets the account records ready to begin tracking results for the next fiscal year. So now we have to remind ourselves of the differences between permanent and temporary accounts. If you remember from Chapter 3, permanent accounts are accounts that track financial results from year to year by carrying their ending balances into the next year. So these would be accounts such as assets, liabilities, and the stockholders' equity accounts, which are the stock accounts and retained earnings. The temporary accounts track financial results for only 1 year at a time and then are closed out or zeroed out at the end of the year after the financial statements have been prepared, and those are your revenues, expenses, and dividends. So there's two purposes of our closing entries. The first is to transfer the net income or loss and the dividends into retained earnings, just like on the statement of retained earnings. Let's take a look at that to remind ourselves. On the statement of retained earnings, we start with our beginning retained earnings. That's the accumulated net income less dividends from prior years. Then we add in the net income or earnings for this year, and we subtract out the dividends. So what our closing entries do is they accomplish that step. But instead of on a report, they do it in our actual accounts, and we only do this at year end. We're going to add in net income and subtract out the dividends. So in step one, first purpose, we transfer our net income or loss and dividends into retained earnings, just like on the statement of retained earnings. The second purpose is to establish zero balances in all of our income statement and dividend accounts. In other words, the revenues, expenses, and dividends, because we want to start the next year fresh. Think about it this way. If you've ever watched the Olympics or any timed competitive sport, perhaps it's a sprint. Once one race is completed, do they simply restart the clock based on the current time that's on there? No, they set it back to 0. And then they run the next race. So each race is individually timed. The same thing with our accounting year. We want to set the clock back to 0, set the records back to 0 to track 1 year at a time. Our closing entries are fairly easy to do. There's 2 of them. First, we do the opposite with our revenue and expense accounts. We debit each revenue account for the amount of its credit balance and credit each expense account for the amount of its debit balance. Then we add up the debits, add up the credits, and subtract. We find the difference between the debits and credits, and we put that amount on the smaller side, and we label the account to be used as retained earnings. That puts the net income into the retained earnings account, or subtracts out the net loss. The second journal entry is to debit retained earnings for the amount of the dividends account and credit the dividends account. And that will set all the revenues, expenses, and dividends back to 0. The very last step in our accounting year is to do a post-closing, that means after closing, trial balance to check that the debits and credits and all the debits equal credits and that all the temporary accounts have been closed. Remember, the temporary accounts are the revenues, expenses, and dividends. At that point, they should all have 0 balances. And we also want to check to make sure that the retained earnings account balance matches the ending balance on the statement of retained earnings. That only happens at year end. Okay, so let's take a look at page 171 in our text. And on page 171, we have the 2 closing journal entries. We're going to take our account balances and we're going to debit each revenue and credit each expense. So if we take a look at our revenues here, for example, we have a credit balance in the service revenue account of $12,100 and a credit balance in the service revenue account of $3,250. We're going to do the opposite. We're going to debit them because we want to force that balance to be 0. Once these are posted here and here, then the account balances will be 0. because 12,100 minus 12,100 equals 0 for the sales revenue account. The same thing with service revenue. Then we're going to take all of our expense accounts. These all have debit balances. We're going to do the opposite. We're going to credit each one of them. And when we credit them, for example, let's see, depreciation expense. We credit for 400. That causes the depreciation expense account to have a 0 balance, so that all of our expense accounts will be 0. Now at this point, pretend you don't see that 800 there for retained earnings. At that point, we're going to add up the debits, that's 15,350, and add up the credits, and again, pretend we don't see that 800 there. And the total of our credits will be 14,550. I'm sorry, my screen froze there for a moment. Okay, so pretend you don't see that 800 there. So when we add up our credits, we have 14,550. So with debits of 15,350 minus credits of 14,550, the difference is 800. We put that on the smaller side, and now the total debits equal the total credits. What you can also do is you can check to make sure that the amount that's going into retained earnings matches your net income on the income statement. And it does. You've just transferred the net income into the retained earnings account. The last step is to close the dividend account, but unfortunately this problem didn't have dividends, so they're just showing you an example. You would debit retained earnings and credit dividends for the amount of the dividends. So now when we look at the retained earnings accounts balance, we've added in our net income, and if we had closed out the dividends, we would have debited here, and that would have subtracted out the dividends. The ending balance of our retained earnings account matches the ending balance on our retained earnings statement. One more step, and that is to prepare a post-closing trial balance. Okay, so at this point, all of your revenues, expenses, and dividend accounts should be 0. And when we add up the total debits and the total credits, they should equal. And that's it. This is the end of Chapter 4. There's a YouTube problem demonstration on how to prepare closing entries that you can use to practice with, and that's in your Chapter 4 folder in Blackboard. Take care.